This is what happened when Adam tried to teach himself to golf. When he tried to teach himself Kung Fu. And when he tried to teach himself to cook. Careful, babe. So when Adam wanted to learn a tap dance, he decided to mirror an expert. That's why when it comes to learning to invest in the stock market, Adam uses the new Mirror, Learn, and Trade platform on Bursa Marketplace. He just needs to register, choose from a selection of analysts to mirror, learn how they manage and strategize their portfolio, and mirror. With 100,000 virtual ringgit. Sign up on bursamarketplace.com. And just like Adam, you can start your investment journey today.
Hello everybody, welcome to this webinar brought to you by Kenanga Investment Bank that is titled Portfolio Timing. Okay, today we are very excited because we are invited a very established speaker in this area, portfolio management area, to share with you on this topic, portfolio timing. Now, isn't that intriguing that we also have timing in portfolio management? So today we are going to learn about it and how you can be your own fund manager, because through proper portfolio management you'll be able to become your own fund manager. All right, so this webinar is brought to you by Kenanga Investment Bank and managed by Wealthford International. So this is Shen Chu, I'll be moderator for this session. Now, so before we proceed, just want to clarify on the disclaimer. So whatever we share on this webinar is only for educational purpose. In no way that we give any buy or sell signal to any companies that we study in this webinar. So if you decide to buy or sell any companies, you do it at your own risk. All right. Now we still have one more Kenanga webinar for the remainder of this year. That is in December. Okay, the topic is on the cups of recovery. So in this segment, the speaker Ko Hwa Soon, which is the head of research of Kenanga Investment Bank, will talk about the Malaysian economic outlook in 2021. So be sure that you register for the session. We'll give you the link to register in a short while towards the end of this webinar. So allow me to introduce the speaker today. So he is an engineer by training. So he's none other than David Poh. David began his career as an engineer in the telecommunications industry for 10 years before turning to his passion in value investing. He served as a director in a local equities education and research firm for 3 years, managing research efforts and delivering advanced value investing and portfolio management education series. So thereafter, he stepped out to pursue his own aspirations, establishing the Spiral Thinker Group, a collaborative alliance to promote intelligence value investing and develop algorithm-based adaptive portfolio strategies for sustainable and long-term wealth creation. So David now is a full-time investor and dedicates his time and resources to nurture the youth in financial literacy. It is often invited to speak in broker seminars, webinars, as well as other Bursa endorsed events, and his professional comments and opinions on value investing are featured in business publications like Focus Malaysia. David also provides consultation services in value investing and advanced portfolio strategies for high net worth individuals. So David, are you ready?
Yes, Shane, I'm ready. Thank you very much.
All right, awesome. So let me hand over the session for you. Now, I think in last year we invited David to talk about the essence of portfolio management. So today I got David back with us to talk about portfolio timing. All right, so over to you, David.
All right, Shane, thank you very much. Good evening, everyone. It's good to be back. It's raining outside, so hopefully you can hear me clearly. So I'll try to speak as close as possible to the microphone. It's good to be back. First and foremost, I would like to thank Kenanga for believing in me and inviting me back to continue the series on portfolio management. Yeah. Also, I would like to thank Shane because I've known Shane for many years and I think he's a great guy. So why this title? Yeah, portfolio timing. Be your own fund manager. Now, what we realize is actually there are a lot of courses out there, or webinars, or talks out there that teach people how to pick stocks. But a lot of people do not realize that stock picking is just half of the story. The other half of the story is how you manage the investments on your hand. Now, you may be thinking, hey, I only have a small capital, right? So do I really need to really need to manage my own fund or my own portfolio? Well, to put it very simply, as long as you have more than 2 stocks in your portfolio or in your trading account, hopefully it's Kenanga, you need to know how to manage the stocks, all right, in your portfolio. That is why it is essential that you learn at least the basics on how to set up your portfolio or your fund, and then how to at least manage it along the way, how to rebalance. And that is why we have this topic tonight, right? So tonight is about portfolio timing. Be your own fund manager. Yeah. Okay. So let me see if I can do the annotation spotlight. Okay. Okay, there you go. Now, again, this, like what Shane has mentioned, this is the second series. So just a little bit of introduction to recap what we have talked about last year. So it has been 1 year since I talked about this. Then tonight is all about portfolio timing. So before that, we're going to talk a little bit about stock timing and how different it is to portfolio timing. Then in the portfolio timing elements, we're going to talk a little bit about what is a portfolio PE as opposed to dividend yield. And then something more interesting, we're going to talk about the 52-week volatility range and some case studies to help you, to bring home the essence of portfolio timing. All right, so without much further ado, this is just a recap of what we have spoken about last year in, I think, almost exactly 1 year ago, about the essence of portfolio management, whereby we went through 4 basic concepts, which is why is portfolio management necessary, and how to construct your portfolio, the essential parameters that you need to know, at least the basic ones to start your portfolio as well as to manage along the way, and last but not least, to optimize risk and performance. So for tonight, our focus, since this is the second installment, our focus will be on optimizing risk as well as performance from a portfolio timing point of view. Okay, so we move on to what is the difference between stock timing and portfolio timing. Yeah. Okay, just give me a second. Right. So again, when it comes to timing for stocks, right? Basically, there are 2 types of risks, right? We call it the fundamental risks, and the second one is the timing risk. So what makes a fundamental risk of a stock? Now, naturally, it's the nature of the business. You have to understand, right, whether it is a risky business. For example, before COVID-19, right, no one in the right mind would think that airlines will have their planes grounded grounded and without flying. So you have to understand the nature of the business and what are the threats that will disrupt the normal operations of that business. Now, in other circumstances, business usually go through these cycles: the expansion, the peak, contraction, the trough, so on and so forth. Then other external factors like interest rates, valuation models, as well as other factors that is not internal or coming from the business itself, right? So these are the basic fundamental risks when it comes to stock. When it comes to timing, it's the same as well. So we look at yields. A lot of people are familiar with PE, which is price over earnings ratio. But for us, we normally look at the inverse, which is the earnings yield. So I hope you remember. If you don't, please, you can go back to, you can watch the earlier videos from last year, which is available in Shane's YouTube page. Yeah. So the yields include earnings yield, dividend yield, cash flow yield, which is more advanced. Then of course we have the average balance cost per share, other technical indicators if you are into it. And last but not least, a lot of people do not know this, the timing risk is also can be relevant to your own risk appetite. For example, if you are a retiree and you do not wish to take too much risk, right? So you may be more sensitive to fluctuations of the market. So you may not want to put stocks that are very highly volatile in a portfolio, and vice versa if you are the young chap who don't mind taking a little bit more risk because you have a longer investment period, right? So these are both the fundamental risk and the timing risk that we should take care of from a stock point of view. Now, I showed this chart before in the first installment of Essence of Portfolio Management, but I used AirAsia at that time. So for tonight, since in the other webinars by Brusa Malaysia, I've talked a lot about semiconductor. I thought of showing Inari in this webinar tonight. So the blue line indicates the price chart. So this chart was between 2019 March until 2020, just recently, November. All right. So as you can see, price, no matter how good or bad your stock is, right, it will go through a normal volatility, gyrations like this all along the way. This is just the nature of the market. Now, what is most important is what you do, with the shares on your hand, with the stocks in the portfolio. Now, the red line here denotes the average balance cost per share, and then the gray bars, which is on the background, denotes the quantity of shares held in this particular portfolio. Now, as you can see, what we're trying to do here is we try to minimize the average balance cost as low as possible. Now, of course, ideally, you want to have free shares, right? But still having a meaningful amount of shares. Now, this is akin to, when you buy a house and then many years ago, which cost, say, $500,000 ringgit, and then along the years, you rent out the house, and then you're getting this rental income, and then by a number of years, perhaps 10, 15, 20 years later, you recoup all your capital. So the carrying balance cost of your house is zero, but the asset is still there, and the asset is still generating cash flow for you. So that's the analogy to a investment in house. In the stock, it's the same, because stocks you enjoy two types of profits. One is the capital gain, and the secondly is the dividends that you receive from owning the stock, right? So as you can see here, so most of the time as the stock price goes up, we sell the share on hand to a lower number, the average balance cost will reduce, okay, so on and so forth. And then when we buy, it will go up. Now, our ultimate goal on the individual stock point of view is to have meaningful number of shares in our portfolio that has a very as low as possible the average balance cost, so that we can enjoy the rest of the the length of our investment journey. Just let the business run, and then you don't really care about what the market does. Now, this is one stock. Why I'm showing you this is because depending on the number of stocks you have in a portfolio, right? Actually, the ultimate goal is to have all the stocks in a portfolio that behaves like this. Then you can say, oh, okay, I can relax in my portfolio. I don't really need to, care about the market. In fact, you love the volatility because you can buy when the price is down, you can sell when the price is up. Now, isn't this a good idea? Because you can actually, use this as a legacy to your beneficiary. You can will it away, say, oh, I want to give my children, my grandchildren this portfolio. So it can be done. All right. So now, when it comes to portfolio timing, the basics or the principles are the same. So we still have the fundamental risk and the timing risk. Now, what are the fundamental risks of a portfolio? First, we have the stock weightages. Stock weightages means what is the carrying weight of that particular portfolio, of that particular stock against your total portfolio. For example, if you invest in a stock like Inari before, and the market rate, the market value is say 10,000, and your total portfolio value is 100,000, then it means that the stock weightage of Inari in this portfolio is 10%. Now, if you have another stock, say AirAsia, that carries a market value of 15,000, so there will be 15% of the total portfolio value, so on and so forth. Now, the other one is industry exposures. Now, a lot of people do not realize that sometimes they are overly exposed to a particular industry in their portfolio. Now, of course, if the industry is on a bull run, you enjoy a lot of benefits, right? But what if that particular sector turns? You know, just give you an example. Back in 2017 and 18, because we are predominantly very tech centered, so we have a lot of tech stocks. Now, of course, in 2017, we enjoyed the bull run of tech, right? Then what happened in 2018, 2019 was, you know, Donald Trump became the president of the United States, and boom, the US-China trade war. So because of our heavy weightage on the tech industry, right, our portfolio suffered a lot, right? Because of the tank, when the tech industry tanked because of the US-China trade war, it actually brings down our portfolio a lot, right? Now, the other one is, of course, is cash balance. Now, depending on your risk appetite, some people believe that, you know, they should be fully invested all the time. But for us, we always believe there must be a balance, right? There must be a balance, okay? Later on, I'll show you a little bit of a case study on what it means by this. Now, next is the timing risk of a portfolio, and this will be the focus of our webinar tonight. Again, portfolio also have the yields, the earnings yield, the dividend yield, the cash flow yield. I'll show you this later. All right. Then we also have the other pure timing risk called the 52-week volatility windows. I will also give you guys a basics, the basics of this and how you can utilize it in your portfolio management, right? Then of course we have other more advanced way of managing a portfolio timing risk through the average balance cost per share. Again, same, as well as your own investment objectives. Okay, so without much further ado, before that, let me show you. So this is what I shared with you guys last year, back in December 2019, right? So I came out with this. I showed you one of the portfolios that I have, a 100,000 model portfolio. We started sometime in the beginning of 2019. So by December, it was about 40 to 52 weeks. All right. So at that time, the portfolio was doing about, I say, 14% absolute return. So it was a good year, not too bad. Later on, I'll show you an update of this portfolio, and you'll be surprised. Okay. Now, so let's move on to the next topic, which is on timing, the portfolio PE, or price earnings use ratio, as well as the dividend yield. Okay. Now, so let's start with recapping what is the definition of PE, right? Now, PE stands for price to earnings ratio. So on a individual stock level, all right, it is basically the stock price divided by the earnings per share, and we value it by the multiple times. For example, if that stock is a business that generates 10 cents per share, 10 cents of earnings per share every single year, and the market rate of this stock is trading at $1, 1 ringgit. So if you take 1 ringgit divided by 0.1, that will give you a PE of 10 times. So what it means is, assuming status quo, assuming business as usual for the next, a number of years, right? You need 10 years, because 10 times, right? You need 10 years for you to recuperate your investment in this company or in this stock, right? Because it takes 10 years multiplied by 10 cents to give you back $1. So that's the essence of PE. Now, earnings yield is basically just the inverse of PE, and which means that we take earnings per share divided by the stock price and multiply by 100%. And why do we prefer to use earnings yield? It's because we can measure it, or we can gauge it against other references like your FD rate, your cost of borrowing, so on and so forth. Now, for example, now I think the FD rate is pretty dismal. I think you'll be very lucky if you can get 2% per annum for your dividends. For your FD rate. So which means that if I have an alternative of a business that can give me an earnings yield of, say, 4% or 6% or 8%, right? That means that it is much better. The return of, we're talking purely from the point of view of a business, right? It's much better than putting in the FD. But of course, business carries risk, yeah? So again, you have to see whether you can take the risk or not, okay? So again, this is the example that I've shared with you just now. So $1 stock price, earnings per share says 5 cents. You just plug in the formula, you get 5% earnings yield, all right? Now, when it comes to portfolio, remember, a portfolio consists of more than one stock. Say you have 2 stocks or 3 stocks. So the N will be the number of stocks that you have. All right. So those of you who are engineers or who are those who love mathematics, right? You understand this very quickly. So basically, the portfolio PE. All right. We calculate the PE first, then we get we consolidate the total PE, then we inverse it to get the portfolio PE. All right. So without let me show you visually through an example, to illustrate what is the meaning of this. Okay. Now, say again, this is the model portfolio of 100K, which started in 15 on January 2019, and this is the real portfolio allocation when it started out. All right, remember those time that was way before COVID-19, so everyone was, AirAsia. Wait, how can AirAsia go wrong, right? This kind of business is like Tony Fernandez is cashing his profits every single day. So in this portfolio, we have 100,000. We have an allocation for 6 stocks: AirAsia, TunePro, TM, UGTech, Getronic, Elsoft, spread over different industries and different Peter Lynch categories. Okay. Now, as you can see, each of these stocks will have their own earnings yield at that particular price. For example, AirAsia at 291, and based on their latest earnings per share, the earnings yield works out to be 16.7%, which is pretty high, for a high growth business. All right. Then by the same principle, TunePro was yielding about 11%. TM was about, again, 9.6, 10%. UGTech was about 6.5, Getronic 5.3, Elsoft 4.4. Now, you can easily get this information from any database or even from your Kenanga trading app, right? So I believe Kenanga has this app, all right, where you can easily get this information. Now, how do you get the portfolio PE, which then translates to portfolio earnings? It's very simple. You see, you have this. You need to decide what is your allocation for each stock. Now, in this example, we allocate 25% for AirAsia, 15% for TunePro, 10% from TM, 20% from UGTech, and then 50% each for Getronic and Elsoft. So what we do now next is actually to multiply the. Let me just put next. Yep. So what we do is we take the 25%. Multiply by the earnings yield of 16.7% to get 4.2%. All right, so that is for AirAsia. Now, of course, AirAsia alone, assuming your portfolio only has one stock, which is AirAsia, 100% you allocate for AirAsia, then your portfolio earnings yield will be 16.7%. Now, because you do not allocate everything to one stock, you spread it over 6 stocks, for example, like this case study, right? So we had to find what is the weightages of these earnings yield for each of these stocks and work out by here, all right, on the right hand side. So the incidental EY, the weighted EY for AirAsia will be 4.2, TunePro will be 1.6, TM will be 1%, UGTech will be 1.3, Getronic will be 0.8, and also 0.7. Now, what you do next is you sum up all these weighted EYs to come up with a total of 9.5% weighted earnings yield for this portfolio. And if we inverse it, it will translate to a PE of 10.5 times. Now, this is very important because you have to ask yourself now whether you are a young investor or you are very risk loving or risk adverse, right? Or you are a retiree who do not want to have a lot of volatility in your investments, right? This will be very important. Why? Because now, as I mentioned, we compare EY with the reference like FD, right? So the FD, let's say today the FD is 2%, and you come out with this portfolio allocation of 9.5%, which means this portfolio, in theory, should at least give you a return of 3 to 4 times against your FD rate. Okay. Now, to some people, they may think that 9.5% is really not that attractive. I prefer to take more risk because I'm looking for higher returns. So in that case, you may want to look for stocks that gives you a higher PE, higher growth rate. Okay, so that's the way we look at it. Okay, so this is just a sample. This is not a stock pick session, yeah. So remember the disclaimer. And anyway, this allocation was way back in January 2019. This portfolio has evolved so much since then. I'll show you later. Okay, so basically this illustration just show you what is the meaning of this formula here. All right, the portfolio PE is a summation of individual stocks weighted by allocation. Okay, now next we look at the dividend yield. Dividend yield again, just like EY, is basically you replace the earnings per share by dividends per share, and you multiply by 100%, and you get the dividend yield. And we normally use dividend yield, and we compare it with especially the FD rate to see, you know, how attractive is this stock as an investment, you know, from the point of view of how much dividends they give. Because a lot of people, there are many people who like to trade every day, and there are also people who like to, you know, don't really want to look at their portfolio. Just okay, I just buy this and hope for long term. And for that particular case, for those group of investors, then dividend plays a huge role. Okay, as usual, you know, some examples here. So if your stock price is $1 and they pay consistently, say 5 cents per share every single year, then you use the formula. So that stock will give you a dividend of 5%. On the other hand, if another stock trading at $1 and gives you a dividends per share of 10 cents, that will give you a 10% dividend yield. You may think, hey David, how come? Is it possible, you know, that there are stocks that gives us 10% dividend yield? Well, there are, and but it may not happen all the time. And I can tell you one thing. Normally, when market is very bad, when market tanks, you know, when everything is so pessimistic, when the share price keeps on coming down, assuming there's nothing wrong with the business, which means that the business can still pay out the same amount of dividends, right? That is where your dividend yield will shoot up. Very simple from this formula here. If your dividends per share stays the same, which is, you know, didn't change or didn't go or come down, but your share price comes down. Your share price comes down, your dividend per share stays the same. In essence, your dividend yield will go up. Vice versa, if your share price suddenly shoot up to the sky for whatever reason, but business doesn't change, business is still the same, they still pay the same dividend, your dividend yield will drop. That is why a lot of people use dividend yield or earnings yield as a timing for the stock. All right. Now you can also use the same for your portfolio, especially for rebalancing. Okay, and we'll talk a little bit about that later on. Okay, again, it's the same formula here, but this is based on dividend yields. So again, using the same allocation table just now, now we just replace the EY by DY. So this is what we get, yeah. So for this particular, for this portfolio, the dividend yield, the portfolio weighted dividend yield is about 5%, which is not bad, you know, assuming you have a mix of high growth, turnaround, as well as medium growth stocks that can give us 5%, assuming of course all these 6 stocks will give us the same amount of dividends as last year. It's not bad. You know why? Because if say your KGAR target, say you only aim to do 15% of a capital gain every single year, portfolio return, which is about, you know, 5 times of your FD rate, which is pretty good. Then assuming all these stocks still pay the same dividends, all right, you only need to achieve another capital gain of 10%. Why 10%? Because 15 minus 5% equals to 10%. So you only need to wait for each of these stocks to grow up 10% in that year. It may happen soon, in the beginning, it may happen in the middle, it may happen towards the end, it may not happen at all. All right. So as long as your portfolio on average, your stocks on average can give you 10% capital gain, right? It means that you would have achieved your KGAR target for that year. Now, KGAR refers to compounding annual growth rate. Okay. Now, say if you are a retiree who do not want to take a lot of risks, you know, and your portfolio target is only 10% per annum. It makes it even easy because right now your portfolio DY is already 5%. And guess how much how much of capital gain do you need for you to achieve your goal, right? 10 minus 5 equals to 5%. So all your stocks just need to go up by 5%, then you reach your target already for that single year. Okay. Now, of course, this is just theory lah. Now, whether it's doable depends on your discipline. All right. Now, a lot of us, even myself included, I'm just human. We see the stock price, you know, go up, jumping up and down every single day. We get excited as well. Yeah. Okay. So just a recap, you know, the assumptions as well as limitations of the PE and DY, right? So Morningstar defines the PE ratio as a fund as the weighted average of the price earnings ratios of the stocks in the fund's portfolio, which we shared. So whatever we use just now, our calculation is actually based on the definition of by the Morningstar. Okay. Now, what are the limitations of using this as a portfolio timing? Again, it's the same as on the stock level, right? Outliers will make these ratios meaningless. Now, what are the meaning outliers? When the numbers are too high, because of say, maybe just give you an example. Now, what are the outliers that will render these ratios or these yields meaningless? First and foremost, extremely high PE or dividend yield. Sometimes you've got to be very careful, especially dividend yield. Now, sometimes you may come across a stock that gives us excessively high dividend yield, say 10%, 15%, 20%, 30%, right? It may happen, but you should check whether it is due to normal dividends that they give or because they may be giving special dividends. Special dividends will bump up the dividend yield straight away, no doubt about that. But the question is, will they be able to give us the same dividend next year? So that's the big question that you need to ask. PE is the same or earnings yield is the same. Sometimes a business may have a bumper year for whatever reason, or they may have sold an asset at a very nice profit, and they have to recognize that profit, although it is not a core business operation, they have to recognize that profit into their P&L, profit and loss, which will increase suddenly, shoot up the earnings. So it will definitely skew the earnings yield, right? So you got to be careful when it comes to this kind of situation, right? Most of the time we will normalize it, meaning we take out these outliers and then we see what is the normal PE, EY or DY. Okay. Now the other thing is companies that are not profitable, meaning they are doing net loss, right? The earnings yield should be zero. Stocks that do not pay dividends should be assigned a dividend yield of zero. So coming back to here, if it's dividend yield zero, just put zero, meaning, for example, if A share do not pay dividend for that year, dividend yield is zero. Although you put 25%, the weighted DY will still be zero. Okay, so that's the meaning of this. Okay, now, of course, other than PE, EY, or DY, right, we can actually expand the same principle by using other yields like operating cash flow or even free cash flow, even more stringent. Okay, but for tonight, I'm not going to talk about that. Now, whatever I've talked about up to now, it is the best to be applied to match your risk profile against your portfolio allocation. Now, I don't know if you remember from the first installment, portfolio allocation means a plan of what you want to invest in, how much you are willing to spend, but it does not necessarily mean on day one you just deploy all your capital to buy those stocks at that price, at that quantity. No. It basically means you are allocating, putting aside a specific amount of capital to buy that particular stock, A, B, C, and D. Now, you may want to wait for the market to give you a discount before you buy more, or you want to wait for, say, the business will report better earnings for you to increase your investment. But you need to know how much you would have allocated, because if you do not do that, remember, all right, what you cannot measure, you cannot improve. All right, then you may not know what you are doing along the way. It's very easy for us to get sidetracked along the way, especially when we do not have a plan. Okay, so just to recap, whatever we shared in terms of portfolio PE and DOR is best for during the allocation stage. All right, so try it out. If you want to be your own fund manager, you've got to follow these steps. Yeah, not to say market opens tomorrow, just see what can buy and then just right along the way. No such thing. Okay. Right, so this is a sample allocation, just to recap. So now we put EY and DY together. As you can see, this is a pretty good portfolio. For your information, the owner of this portfolio is a business owner, 100,000. So I think he is, I guess, 40 plus years old. He has his own business and 2 children. Okay, so this is a pretty good portfolio. Now, next, I'm going to talk a bit more about the pure timing indicator, which is the 52-week volatility range, which actually gives you more color of how you can enhance your allocation plan for your portfolio. Okay, so next we're going to talk about the 52-week volatility indicator. First, the definitions. Now, as I mentioned before, early in this webinar, stock prices are volatile in nature. All right, so it creates a lot of opportunities for us to buy more when it comes down, to sell when it goes up. But as human nature has it, right? We can't help it. You know, we are very fickle-minded. That every time we buy a stock, what do we hope for? We hope for the price to go up. But when the price goes up, then we say, yeah, I should have bought more. All right, and then of course, logically, when we buy a stock, when it becomes cheaper, we should buy more. But because of the fear factor, we always do not execute as per plan. Okay, but that's about the psychology. Hopefully next year, Chun Xian or Kananga will invite me back, so where I will talk a little bit more about the interesting topic called the psychology of investment. Okay, now back to the 52 window. The definition is basically a rolling 12-month period. Now, for example, today is 26th of November 2020. So the 52-week window before this date is actually 27th of November 2019 until today, 26th of November 2020. So that will make up a 52-week rolling window. Okay, so this is just an example. Now, in this window, the stock price would have moved out to a highest point, came down to a lowest point, and it will be a certain level today. For example, if the current stock price is $1, okay, and in that 52-week window before, the stock achieved a high point of $1.20 and a lower point of 60 cents, right? And visually, you can see from here, all right, so this is the current price, this is the limits, sorry, this is the upper boundary and the lower boundary of that 52-week window. So you can at least gauge, you know, what is the timing risk of this particular stock. Okay, and this is the reason why we use a 52-week window, a volatility range, to estimate what is the timing risk of this particular stock. Okay, now again, a formula again, it's very simple. 52-week volatility indicator is basically defined as the current price minus the 52-week low divided by the range, which is the difference between 52-week high and 52-week low, multiplied by 100%. So it's very simple. Let me go back to the previous slide. Let me see if I can get this. Somehow today, can't seem to do this. Yeah, I don't know why I can't seem to make the drawing tool. Yeah, never mind. Okay, never mind. So if you can, hopefully you can see my mouse. So what the 52-week volatility indicator means, at $1 against the volatility range, you know, it means that it has gone up this much from 60 cents. All right, gone up this much from 60 cents. It's very close to 120. Now, of course, if the stock price today is say 70 cents, 80 cents, then the timing risk on theory is lower because, you know, it has a less room to go down compared to when it's at $1. Now, this is very theoretical, but there is a practical angle to it, which I'll show you later. Okay, again, this is just the formula. Now, there are two boundaries or two limits that we have to take care of for this volatility. And it is a hard limit, right? So the indicator cannot go beyond 100% and it cannot go below 0%. I give you a reason why. It's very simple. Now, using the same example just now of 120 and 60 cents. So if you take current price $1, you multiply by the law of bless you, Shane, 60 cents, and then you multiply by the range 120 minus 60 cents, right? You get a number, right? Now, what if? Let me ask you this question: what if the current price is exactly on the 52-week high at 120? All right. Now you come back to this formula. You take 120. 120 is the current high, right? So you replace current price with 52-week high. You basically get 1 here. You get 1 here means it's 100% because 1 multiplied by 100% equals to 1, equals to 100%. Now, what if tomorrow, say for whatever reason, the stock price went up to 130? All right. So don't forget, when the stock price is 130, it has created a new 52-week high. So you have to replace the 52-week high to 130 and not 120 anymore. So back to this formula, current price is 130, which is equal to the high price. The formula will use the same 100%. So this, why I'm showing you this is because this is a moving indicator. It doesn't mean that when it reach 100%, yes, it's at the highest, I should sell everything now. Not necessarily, okay? The same applies to when the stock price went tanked down all the way to the 52-week low. For example, for whatever reason, say the current price 60 cents in this example, right? So at 60 cents here, then the volatility range should be 0. But it does not mean that the share price cannot go below than 60 cents tomorrow, the next week, or the next month. Because at, say it went down to 50 cents, right? Then it will create a new low, but then the moving indicator, sorry, the 52-week volatility indicator will still be 0. Okay, now enough about theory. Let's go to some practical example. Okay, so in this case, just now, just the same $1 and then the range of 120 between 120 and 60 cents. The volatility range should be 60%, which means that the stock price at $1 has moved up 67% against the volatility, the 52-week window. So I repeat, based on this scenario, when the share price is $1, it has moved out 67% of the time, 60% from the low against the backdrop of the 52-week range, the volatility range. Okay, now likewise, if the share price is instead of $1 is at 80 cents, as I mentioned just now, you apply the same formula here, it would mean that at 80 cents, the stock price has gone up only 33% above 60 cents against the backdrop of a 60 cent range. Okay, now how do we apply this? It's very simple. A high 52-week volatility indicator would imply higher timing risks. Okay, now I know if you are pure technical, guy, a trader, right? You say, hey, when the stock price goes up, it means it break up, it will go higher. Okay, so that's beside the point because now we're only looking at statistics. Statistically, for this example, the risk statistically or theoretically is higher compared to this scenario. Okay, all things equal. All right. The same again, lower 52-week volatility indicator would imply a lower timing risk. So visually, if so, I have a stock 1 like this and stock 2 with the volatility range like this. Let me ask you this question. On day 1, when you want to plan your allocation, right? Assuming stock 1 and 2 are the same business, same stock, same characteristic, all things equal, right? How much would you apply the same allocation to these two stocks, knowing that one, the volatility indicator is 31%, which means it has gone up 31% from the low, or would you put more on the stock that has gone up 92% from the low in the same 52-week range? Okay, now, of course, we are talking purely from a risk management point of view. And if that is true, then you would want to perhaps tweak your allocation a little bit to put more on stock 1 or less for stock 2. Now, this is how we balance the risk. It is not about maximizing your profit. It is about balancing or optimizing your risks. Okay. Now, unlike PE and DY, the 52-week volatility indicator is more versatile. All right, because it changes every single day, and it is a pure timing risk. Now, based on this formula here, as you can see, it's not like the PE where you have earnings per share or dividend yield where you have the dividends per share, right? This is all about price, current price, 52-week highest price, 52-week lowest price, okay? So it has got nothing to do about the business. That's why we call it a pure timing risk indicator, okay? Now, it is very useful, especially during the allocation step, where you can deploy your marker. Now, I don't know if you remember the marker. Marker means the first block of shares you buy, the first block of quantity that you buy. That's called a marker. It can be used for rebalancing purposes as well. All right. Now, if I put everything together, now we got the EY, DY, and the volatility range, right? Now, for example, this is a case study. Now, say during your first allocation, calculation, this is what you come up with. Now, but looking at things now, of course, with the EY, DY, and the 52-week volatility information now, right? Actually, can we enhance this allocation plan even more? We can, but this is just a suggestion. Now, portfolio management or fund management is really more an art than a science. You need to have the science to support your decision or your objectives, but how you execute it, how you plan it, how you allocate is really depending very much on yourself. Okay, now for this case study, actually we can tweak the portfolio allocation a little bit. For example, now AirAsia originally has 25% allocation because say the earnings yield is very high, dividend yield is not bad, 4%, right? But if you look at the 52-week volatility range, it has the highest volatility indicator compared to the rest of the other 5 stocks. Now, so in this case, you can say, hey, instead of putting 25%, which is a little bit risky, because it's so high already, right? Can I reduce it a little bit more so that I can, move the allocation to other stocks, good stocks, which are, having a lower timing risk in terms of the volatility range. Now, for example, I can instead of 25%, I can reduce this allocation to 15%. All right, so 10%. Now, this 10% has to go somewhere, right? Because at the end of the day, you need to allocate 100% of capital. This 10% say can go to TM. Why? Because TM, it's not bad. Original intention was to allocate 10% only. It's yielding about 10%, great dividend yield 8%. To me, when I see a good stock like this, although TM is a pseudo GLC, right? But it's still a good company. 8.3%. Dividend, it's like 3 times more than my FD. Sorry, 3 times more than my FD rate now, right? It's a no-brainer to me. And the volatility range is only 11%. So I can say, hey, I want to move a little bit of allocation for AirAsia to TM like this. So instead of 25% AirAsia and 10% TM, it will result to 15% AirAsia and 20% TM. You see how we can use these 52-week volatility range to enhance our allocation plan. The same goes to UGTech. Again, this is just for illustration. So I take 5% away from the initial allocation of 20% of UGTech, put it into Getronic, so Getronic becomes 20%. Okay, so this is actually what is really happened in this portfolio, so I'm going to show you what along the way how we rebalance it. Okay, now, so this portfolio started, I think, in again the same month of January 15, 2019. So after a couple of weeks already, wow, see that time 19 was a good year, right? You see, straight away make profits already, while still having 61% cash. Now remember, here I actually moved some allocation to TM. Now TM is total 20%, right? Now please don't ask me why, but for whatever reason I can't remember, we fully deployed the allocation for TM at that particular time, 20%. 19.4% is almost the same. Okay, right? Then the rest, we do not fully utilize the allocation, which means we still have 61% cash. All right. Now, of course, along the way, we were trading, so on and so forth. Now, I give you an example of how we trade up and trade down. Yeah. Now, you see AirAsia, right? So although it's a great company, right? You see, because of market volatility, right, along the month, AirAsia went from 296 down to 227, 273, down to 269, down to 266. Now, because we did not fully utilize our allocation or deploy our allocation since day one, which means we have spare cash. That's why we love it when the stock price comes down. In fact, when the stock price comes down, the more it comes down, the more we buy. All right. And again, a good company, as long as the stock price comes down, as long as the business is good, eventually the stock price will bounce back up, just like a tennis ball, right? So when the stock price start to move up, lowest was 266, then at 286 we bought back, 286 we sold some, 290 we sold even more, 286 we sold more, 282 we sold more. All right, so this is how we buy and sell the stock. This is about trading. Now of course this is easy because as the stock price comes down, we buy more. Now sometimes you can also buy on the way up. All right, but of course you must know what is your reason to do that, because when you buy on the way up, you're basically taking a higher risk. Now for this particular portfolio, in fact, the investment thesis for TunePro and AirAsia are the same, because TunePro actually latched on AirAsia's business to generate revenue and profits. So here we were that time we were very optimistic about TunePro's business prospect. That is why, although we first bought 5,000 shares at 61.5 cents, when it went out to 64.5, 65.5, we actually bought more. right? But the essence is still the same. We bought, and then it goes out, we will trade, we will sell the profits, right? So on and so forth. Now, so much so, when we continue to do this, not just for this particular two stocks, we actually did it the same for all the other stocks in the portfolio. Now, eventually, after I guess 5 months down the road for this particular portfolio, you can see that you start to reap profits. Now, of course, in a portfolio, ideally we want to have all the stocks giving us profits, right? But realistically, it won't be the case. Now, at one certain point in time, some stocks will be profitable, some other stocks will be not so profitable or generating loss, just in this case. Now, in a short span of 5 months, you see Asia, initially the profit was only 118 ringgit. It will balloon to 1,598 ringgit just because we were trading here. The same for TunePro. TunePro originally, in January 2019, the profit was only about 116, and it ballooned to 1,524. Now, of course, along the way, we added an extra stock called Carex. Okay, we generated a handsome profit for us. TM, we saw off TM. TM was in January, but we saw it off some along the way, so we do not have TM. But we introduced another stock, I guess. We introduced Inari into this portfolio. Yeah, so Inari was generating profit for us as well. So we keep on doing this. I'm sorry about that. Okay, I hope I didn't mute it. Yeah, sorry about that. Yeah, sometimes too excited. Yeah, my hands flying around. Okay, so we just do this. We just continue to do this along the way, and hopefully, we make more. We should, by right, the aim is to make less mistake compared to your wins. Then overall, you should make consistently profits along the way. Okay, now another way of looking at this, I've got about 8 minutes left, so just maybe wrap up with a couple of more case studies. Other than the portfolio EY, DY, and this 52-week timing, right? Actually, there's another angle that we can look at is how we manage the cash balance. Okay, now in this particular example, you see that when we started out at week 0, it's 100% cash, meaning, of course, when you started out, you pump you deposit your capital with your broker into the trust account. You got no stocks, so it's 100% cash, 0% equities or 0% stocks. Along the way, you will spend the cash to buy the stocks, and then the equity will go up, and then your cash balance will come down. Okay, now the essence of this is when your portfolio goes up, now we must have a GPS like this. Now here, one thing to note is this green line here, which is my KGAR target for this portfolio. Now, I hope you remember from the first installment, the essence of portfolio management, the very first step before you even do your stock pick is to decide what is your KGAR target. What is the profit that I want to look for, that I want to achieve every single year, not just for 1 year, but for as long as you are investing. Now, generally, we use 15% because 50% will double out every 5 years, which is not bad, right? So if I draw a line to depict what should the portfolio be like, what should the portfolio performance be like along the way if I am to achieve 15% per annum, right? So this will be the green line. Now, when the portfolio performance or the portfolio profit is above the green line like this, it means that you are ahead of your target. But sometimes, for whatever reason, the stock market may be very jittery. Donald Trump may, that time, of course, Donald Trump may go head on with China. Local politics may play a role as well. For whatever reason, your portfolio may come down, and if it goes down below the KGAR target line, it means that you are way behind your target. Now, this is very interesting because we can use this as our timing as well. I'll give you an example. Okay. Now, here in this highlighted area here, it basically means that our portfolio performance is higher than our target, which means that we are ahead of time. Now, logically, what should we be doing then? Should we be buying more shares, or we should be selling more shares to conserve cash? Logically speaking. Now, remember, this is about risk management. It is not about maximizing your profit, right? So in this case, logically speaking, based on a risk management angle, I should be selling more shares. I should be raising more cash, right? Because I'm ahead of my target already. Now, conversely, if my portfolio were to come down for whatever reason, by right, I should deploy more cash to buy good stocks, to buy value stocks, which gives me a higher yield, right? That's logical, right? But of course, a lot of times we were gripped by fear when the stock price comes down, and that is why psychology is actually plays a very important role in our investment journey as well. All right, but theoretically, of course, here when the stock price, when the portfolio is above our target, we should be net selling, and conversely, if it's below our target, right, we should be net buying. Now, of course, there is still an element of stock pick. It doesn't mean that if you just close your eye and simply whack, just simply buy across the board. No, you can't do that. Now, later on, I think in the next couple of minutes, I'll share with you a very drastic portfolio rebalancing that happened to us this particular year because, again, this year is the year of unprecedented crisis, right? Okay, so now just a recap, just an update. So what I've showed you up to here is basically up to end of last year. Now, so today the portfolio, this was good as of to last week, I think, because I prepared these slides last week. So this portfolio return has went on from 14% here to about 30% as of last week. I think today is out about 33%. Okay. Now, as you can see here, just like every one of us, we are not God, we cannot predict the future. This portfolio suffered massively, during the global lockdown because of this COVID-19 pandemic, which means that you see at this point, it's already negative, meaning whatever profits that we have gained previously, boom, went back to the market. Of course, you say on hindsight, I should have sold everything here and kept cash, right? Of course, it's easier said than done. On hindsight, everything is so clear. But who would have guessed, that even beginning of the year, who would have guessed that 2020 will become so bad like this? Okay, but that doesn't matter. What matters is how you react to it. Now, again, you may just now I said, right? Hey, David, just now I thought you said when the portfolio is above the KGA target, you should be net selling, and when the portfolio performance is below the KGA target, you should be net buying. But how come in 2020, when it's way below the KGA target, you are raising cash? Now, this is just to show you that we are also human like you, and we are also gripped by fear. At that time, with so much uncertainty, right? Because we don't know how long the lockdown will be, and what kind of devastation that how devastating the the pandemic is to the economy, right? That's why we decided to pull the brakes, sell off most of the stocks, and then to conserve more cash. But we were focusing on one particular sector, all right, which actually helped us this portfolio to regain its a trajectory back to profitability. In fact, it is performing much further than our intended target. Okay, now just a last case study. So this is again this is a new topic that I've talked about tonight only. So please pay attention. Yeah. So this is a real case study of how we rebalance during crisis. Now, just for your information, the pink bars are the cash balance. So on the first week of 2020, we have about 30% cash balance. So 70% is in stocks, 30% in cash. Now, the 70% consists of stocks which are not related, which are not Top Glove, Harta Lega, Supermax, or Kosan. So these are the glove stocks. On the first, second, and third week of 2020, we don't even have a single glove stock. But because of the pandemic, and even earlier on, we said, hey, maybe we should look at some glove stock just in case this COVID-19. That time we didn't even know it's called COVID-19. I just called the Wuhan virus, right? It may balloon, to something which is more serious, and we were glad because why? Along the way, we added Top Glove, Harta Lega, and then we added a little bit of Supermax as well. Okay, so much so that at the highest point you can see here, I think on week 27, which is around May or June this year, we have as high as 50% of the allocation into glove stocks. Now, of course, that time the news was, the glove companies were doing very well. Their orders were backlogged for a year or year and a half. their average selling prices were shooting to the skyrocketing, especially Supermax, because of their own brand model, their own brand model of the business. All right, so we decided to do something drastic. We decided to do something unprecedented. We have close between 40 to 50% of allocation to for this any of these 4 growth stocks, a little bit in others, and then mostly in cash. All right, now this is just to show, this is not to brag about our performance, but this is basically to show you that sometimes when the situation calls for drastic measures, that you just have got to bite the bullet and do what is necessary to protect your portfolio. Now, of course, on hindsight, it's easy to say, actually, we made the right decision that time to increase our allocation into glove stocks, and we enjoy the bull run along the way. As of today, we have less than 3% in glove stocks. We have sold off Top Glove, especially when the Teratai cluster was announced. We thought we assessed the risk and we say, hey, there's a good potential that maybe this cluster may the number of cases may balloon. So we just let's just we have made enough profits. We made handsome profit for off Top Glove. We will come back, but for now we just want to sell off. We focus only on Harta Lega and Supermax, and then of course along the way now I think our allocation is more on tech stocks because technology is I think especially with 5G, right, is on the rise. We have some in very beaten down sectors like construction. We have 1 or 2 construction stocks, all right, for this portfolio. But hopefully I come back again to update you guys what are the stock allocation for this portfolio for now. But that says that's about the end of this webinar session. So before I hand it over back to Shane, allow me to just recap the conclusion. So tonight is about portfolio timing. We talk about how we look at the timing from a portfolio angle, which is the PE or the earnings yield of a portfolio, then DY. I show you the calculation. I show you what are the practical applications, especially for the allocation stage. Then we move on to the pure timing risk. Of course, due to lack of time, we only talk about one, which is the 52-week volatility indicator. I talk a little bit about cash balance and how we practically manage the cash balance along the way, theoretically, and how we practically did it just by using the real case rebalancing during crisis example just now. Of course, there are many other more targets we can use. Okay, but at the end of the day, this process is actually repeating, because along the way you will have to rebalance. Now, don't forget, investment is a long-term journey. It doesn't mean that you invest for 1 year or 2 years, right? Or you invest for fun. Investment taken seriously, right, is a long-term journey. As long as you are alive, right, you should be investing. That is why in a portfolio management, when you are your own fund manager, right, this process will repeat itself, this cycle. Okay, so I hope I've given you a glimpse of how exciting, how possible it is for you to be your own fund manager, and it's a very rewarding process. It will has its up and downs. Don't worry, market will always be there. Okay, with that, I hand over back to you, Shane. Thank you very much.
Thank you so much, David, for your sharing on portfolio timing. I guess many of us also learned a great deal from your experience managing a portfolio, building portfolio, and looking at the weightage and timing risk, the portfolio PE, dividend yield, and so on. That we are now more savvy in constructing our portfolio. Do you agree? If yes, type yes, okay, in the comments, so we know that how helpful in this session to you. Now, if you have any question to ask David, you may put in the Q&A box, then we will address them. Of course, due to overwhelming response in this segment, so we have a full house crowd today, so we may not be able to answer all of your questions. All right, so let me see. I look in my screen. There are many questions on Air Asia. So let me just sum up for those of you who are asking Air Asia. Okay. So now, David, in your point of view, how do you view Air Asia, this company right now? Okay, and then do you still have it in your portfolio?
Okay, before that, I see the Asia question as well. So I think somebody point out that the formula for DY is wrong. So thank you very much for pointing out again. You are right. So please accept my apologies. For this slide, the formula for, wait, what happened to my chair? Sorry. For this slide, the DY, the formula is dividend per share divided by stock price multiplied by 100%. So thank you, Ronnie Kong, for pointing out. I think it shows that you're paying attention. Yeah. So thank you for that. So back to your question about AirAsia. Now, don't forget, you guys can still see the slide in front of you, right?
Yes, correct.
Okay. Can you guys? I think some hope you guys can hear me. Now,
Yes.
this allocation is on 15th of January 2019. Yeah, so AH at the time was in a high growth stock. But today, with the COVID-19, the pandemic, right, the aviation industry, sad to say, without sounding too dark or too pessimistic, will still take a long time for it to recover. In fact, we still do not know what is the extent of the damage of the aviation industry. Now, what do I mean by that? A lot of airlines is closing down. They are looking for funding, for government assistance. And then we feel that the situation has changed, that people may be more afraid to travel as soon as possible. Now, of course, there will be certain group of people, especially youngsters, the travel buffs, who cannot wait to travel. There will be those people, but don't forget, budget airline like AirAsia, right? They thrive on volume, which means that they can only make money, they can only make profits when they hit a certain amount of economy of scale. Now, with all this SOP going on and a reduced number of flights and increased operational costs, you have to have all the SOPs, the check-in procedures, the insurance coverage, so on and so forth, right? The profitability of budget airlines may not return to the heydays so soon. So to answer your question, I guess for the next 6 to 12 months or even longer, there's still a lot of uncertainty for the aviation business. Now, I am talking purely from the point of view of a business. It doesn't mean that the price will not go up, okay? Don't get me wrong. I'm sure that when the vaccine news were to, become very more and more certain, that vaccine will be available, right? All these stocks like airlines, airports, gambling stocks, travel and leisure stock, for sure the market will react. The market will drive the price up because suddenly everything seems to be back to normal. But the business still needs time to show you that it is indeed profitability is coming back. So there are two angles you have to look. One is the market reaction, and the other one is whether it is really substantial, whether the business is really making a comeback. Okay, so I hope I know it's a long way of answering your question. Now, personally, I know there are some questions whether I'm still holding AirAsia. Personally, I do not hold any AirAsia right now, but we are waiting to go back into airline stocks. In fact, other than AirAsia, we are also looking at airport. Malaysia Airport is a wonderful investment grade stock. The dividend yield is quite attractive right now. The balance sheet is very strong. So perhaps for those of you who want to tap into the theme of COVID recovery, right? Other than AirAsia, you can also look at airports. Just a suggestion, not a stock buy. Okay, Shane?
Yeah, we don't do any buy or sell recommendation because none of us are licensed investment advisor. Okay. All right. And next question is all right. If you look at portfolio management, in actively managing of the sample portfolio that you have just shared, what criteria and triggers you use to decide to trade two of the stock, like constantly buy and sell two of the stocks? This question is by Tak Un Pun.
Okay. Now, how frequent or what are your triggering factor for you to trade, right? Actually depends on your criteria. Now, there are two types of investors. If I generalize, right, I call one an active investor and a passive investor. Now, let's look at the simpler case. I have a high school teacher who is, hopefully he's tuned in, right? He's a retiree, and I'm going to use this as an example. A retiree, normally, you know, you want to enjoy life, you want to have yum cha sessions with your friends, you know, just relax. You don't want to take too much risk, you don't want to be so perturbed by the market gyrations, right? So in this case, you may not want to trade so often, and you may use these portfolio indicators that I've shared today, like the EY, the DY, right? To decide whether you want to trade. I'll give you a very simple example. Say UG Tech previously, no, say another, just one arbitrary stock. When you first bought it, the dividend yield was very good, 6%, for example. Okay, and that's the reason why you bought this. For example, in this case, UG Tech, because UG Tech during inception is giving you a yield of 6%. Now, along the way, say the stock price went up because the business was doing very well, but they still give you the same dividends, right? Say it went up to $3. Now, the dividend yield may drop because the share price went up. Dividends per share stay the same. The dividend may drop, say, to 4% or 3%, right? Now, in this case, you may say, hey, I may want, because the dividend is not so attractive anymore because the share price has gone up, which means you make capital gains. You may want to decide, why don't I sell some of this stock, use the money to buy another stock that gives me a higher dividend yield? Say, for example, if UG Tech, just for example, if UG Tech was yielding at 3% at that time, I can sell some of UG Tech to use the money to buy into another stock that gives me a much higher dividend yield than 6%. Sorry, 3%. So that's one way. Now, if you are an active investor, you like to trade, you love the market gyrations, right? So you may want to look for other indicators, not just the EY and DY, right? So as I mentioned here, so other than these, so there are many other ways for you to do timing. So other than 52-week volatility, the cash balance, then also if you are inclined to use technical analysis, you may do so. There's nothing wrong with it, but you need to know what you're doing. Okay, I know technical indicators, they like to do breakout, or so many, and these days there are so many gurus out there that can teach you, right? So I'm sure there are more than one way to skin the cat. So I hope we answered your question just now. All right, thank you very much.
Yeah, definitely. The next question is from Kamal. So how do you do research or timing analysis on which sector to invest? Is it rotation basis?
You mean the sector, is it?
Yeah.
Okay. Thanks for your great question, Kamal. I don't know if you remember, one of my first video with LiveChamp, or with Kananga, I think is the essence of value investing, or the principles of value investing, whereby I shared that our approach to analysis, whether it's stock or especially industrial or sectoral analysis, right, is a top-down basis, meaning we look at, on the macro level, on the high level, what are the sectors that is interesting now, and can at least have a few years of growth, and then we decide. When we choose that particular sector, we will do a bottom-up stock pick to say, in that sector, who are the leaders, who are the most profitable business, and who gives us the best reward to ratio. All right. Now, I'll give you an example. Technology is, to us, in our opinion, the next few years will be the next super cycle of technology. Why? It will be spearheaded by 5G adoption, and then 5G will in turn spur or catalyze a lot of adoption of technologies like automotive, EVs, Internet of Things, so on and so forth. So this, to us, is a big investment thesis, which is good for the next few years. So on a top-down basis, we look at technology. All right. Then on the short-term basis, we look at 5G, and that's why we look at 5G stocks. All right, for this particular quarter or next few months. Now, Sometimes we also look at sectors which are beaten down so bad. For example, construction stocks in Malaysia, I think none of the construction stock except for Masing lah, all right, because Masing has been doing well because they hit all the right notes, like they venture into gloves. Next, I think they're going to venture into vaccine as well. I don't know. So construction stock, a lot of them are beaten down, but as long as you believe that it will come back sometime later, maybe the budget, I think the budget was announced today, so there were some goodies for the construction side, infrastructure, right? So some of these companies may benefit. So in that case, you may want to position yourself to look more into, you want to allocate more resources to look into this beaten down sector. So to answer your question just now, there are two ways to look at it from the top down. Sector that you believe is on a high growth path, or a sector that is very highly beaten down, but you believe that may have a chance to turn around. Okay, so that's about it.
All right. Now the next question is on if our portfolio is negative, so how do we rebalance a negative portfolio?
Can you repeat that, please?
If our portfolio is negative, how do we rebalance a negative portfolio?
You mean negative? It means net loss, Is that what you're trying to say? So your portfolio is losing money, lah?
I think so, lah. I think so, lah. I think that.
Okay. Well, I think this is the best question for tonight. I was waiting for this question, right? Now, I don't know who is the person who asked this question, so good question to you. So I guess your portfolio is in the negative zone, right? Don't worry. All of us has been there before. All of us has been there before, so you're not alone. So the first thing I would suggest you to do is to look at what are the stocks that make up your portfolio. Are they good stocks? Are they stocks that you don't have no idea what they're doing? Are there stocks that because you heard of your friends who say about it, or you read it in i3investor.com, or you read it somewhere on the forum, or you read it in a Facebook, right? You bought into it not knowing what you're doing. So if there are these kind of stocks and it's losing money, right? My suggestion to you is just cut. Just cut. Forget about it. All right. So last time when I first discovered value investing, when I first attended my first course, right? It took me 6 months to realize that, it is better for me to start with a clean slate than drag along my baggage. 6 months. It's because again, like you, I'm human, and it's so hard for me to cut loss, and oh yeah, so sayang, and then all the grandmother story of why I love this stock, right? So of course there'll be some stocks that you believe is good, so you've got to do your own homework, that you believe it has got good potential and is really investing in business, right? So you can keep those stocks. So those stocks, again, when you started a portfolio, there are two types of capital. One capital is cash, very easy. You start, of course, if you start with a fresh portfolio with all cash, it's very easy. But some portfolio is a legacy portfolio, so you've got the mix of cash and stocks. Good stocks or good companies you wish to continue, right? You can keep it in a portfolio, but make sure that you have a meaningful, or you are not overly exposed in terms of the portfolio weightage. Okay, so coming back to your question, again, I would urge you to assess what are the stocks in your portfolio. Take out those you should have no idea what they're doing, that you are speculating. Just take them out, and then start with a clean sheet. Start with as a clean slate, and see how you can actually move forward meaningfully by really investing and not speculating. Okay, but don't worry, you're not alone. All of us, including myself, have gone through this journey before. Right? Thank you.
Definitely. The next question is by David. Same name like you, David, but different surname.
Yeah, I tried to look for the question.
Do you set cut loss limit should any of the stock in your portfolio is not performing as anticipated?
Yeah, again, cut loss is a very personal question. Now, let me give you a few examples, maybe from my own point of view, right? So this is just how I do it practically. It doesn't mean that it is the right way to do it. It doesn't mean that you should not take it as a textbook formula or textbook strategy. It's basically how I do it practically. Now, a lot of things that I do here, what we shared here, right, are the things that we do, the ways that we do it. So it's not from any textbook. It's basically from what we learn along the way, our experience, especially, or what we did wrong. Okay, so coming back to your question, do we really cut loss? Yes, we do. Now, there are two reasons why we cut loss, or I won't, normally I don't say cut loss, I say I sack the CEO. I fire the CEO because I moved my money to another company. So two things. One is the fundamentals of the companies has changed. For example, Asia. Previously, to tell the truth, up to December 2019 and January 2020, right, we were still very much upbeat on Asia, because as much as 20% of our portfolio was invested in Asia alone. This is how confident we were then. Little did we know how wrong we could be, right? So when the situation turned so fast and so drastically downhill, right? We did not cut loss Asia in January. We did not cut loss Asia at 140. We cut loss Asia at 190 cents to $1. So we are also human, right? We cannot get out at the highest price, right? We also cut loss. Sorry to Tony Fernandez, although Tony Fernandez is a good friend, right? We love him, right? We believe in his vision, right? But we need to protect our portfolio bottom line, right? Our portfolio capitals. That's why we sell off Asia entirely, because the fundamentals of the business has changed. All right, and we believe it will take time for it to return to the normal times, or even to the profitability that we used to see. That's one. Second reason is, now say you find yourself in a situation. Let me see if I can find this here. Yeah, here. I hope you guys can see this slide. Now, say if you find yourself in the situation whereby you find yourself, oh my goodness, my portfolio cash is less than 5% or 10%, and you're not very comfortable because you think that, for me, I'm not very comfortable if I have 5% cash, because I'm always afraid the stock market will come down and I have no cash to buy. That is always my fear. So normally when that happens, right, and I found I wanted to buy more of a stock, so what I would do is I scan through my portfolio to pick out which are the stocks which has the least potential to turn around, or the stock that may not be profitable, that should not give me the kind of profits I look for in the next, say, 6 to 12 months. I will sell all these stocks, use the capital to buy the stocks that I want, which I believe will have more potential. So this is what we call rebalancing. So here, of course, we did a very drastic rebalancing. Here, right? So of course, our cash position was still very high, but it's basically almost the same concept here. Okay, so I hope I answer you your question. I give you two angles. One is, just to recap, one is when the fundamental of the business turns. Secondly is, if I'm strapped of cash and I need to raise more cash, this is what I will do as well. All right, Shane?
All right. The next question is by Lina. I think many of us also do not have big portfolio, right? So the question is, how should we practice portfolio management for small portfolios such as less than 20,000?
Small portfolios actually is much easier to compound, to tell the truth. Now, if you're managing a portfolio of 20,000 or 30,000 compared to managing a $1 million or $10 million portfolio, right? The dynamics are very, very different. Trust me. All right. So if your capital is small, don't worry. There are 1,000 stocks listed companies in KLSE, out of which I guess there will be a good 50 stocks which is worth investing, right? Now, if your portfolio capital is small, then you don't go and look for high price stock. Now, when I say high price stock, it does not mean that it is expensive. It just means that the price of the stock is high. For example, if you have a 20,000 portfolio, you cannot buy good stocks like Nestle, right? No matter how you love Nestle, right? Because a Nestle stock price is about 140 ringgit now. If you buy 100 shares, that is 14,000 already. So it means that actually bulk of your money will be allocated into Nestle, right? So for smaller portfolios, you may want to look for lower price stocks, say $1, $2, or even below the $1 range, which is still plenty. All right. So I hope you answer your question. I think we got another, say, 6 minutes more to go.
No, actually the session should end at 9.
Okay.
but never we are extended already. Usually we do 1 hour and 15 minutes for this segment, but don't worry, we extend it for a bit, David. Now let's do one last one. Okay,
Alright.
I see many of the questions on the current vaccine player. Should we include vaccine companies in the portfolio?
Yes, we do have a few vaccine theme thematic stocks in our portfolio. In fact, this Saturday, our group, we have a club called the Intelligent Value Investing Community Connect IVSCC Plus. We are having a club session on Saturday morning. We do it on Zoom, whereby one of the topics we talk about is the vaccine thematic play. Now, vaccine thematic play, there are many ways to skin this cat. So basically, you can either invest in the pharmas, you can invest in the supply chain that will benefit, for example, the transportation, the logistics, the distribution. So I don't want to name stocks because this is not a stock pick session. So I just give you the sectors, the segments. All right. So just recap: logistics, transportation, the pharmaceuticals, even the companies that are able to give you a very big hint. Companies that can provide refrigeration services, and some of the vaccines require very high tech, sub 80 degrees Celsius kind of refrigeration process, right? So not a lot of companies can do that. So I believe that perhaps maybe a couple of these logistics or warehousing companies may benefit. Yeah. Other than that, I would say that's about it. So logistics, warehousing, distribution, distribution of pharmaceuticals, and yeah, that's it. So I hope I answered your question. I try not to give you stock picks because out of respect, right? This is a webinar for portfolio timing, not stock picks.
Yeah, precisely. So of course, those companies you mentioned, David, some are beyond the scope of Malaysian boundary, right?
Sorry?
And some of these companies that you mentioned are beyond Malaysian's boundary, right? I mean, they're
all Malaysian companies.
they're all Malaysian company. Okay, cool. All right, so today, of course, none of us are licensed financial advisors, so we can't give any investment advice. However, in our next session, we have invited the head of Kenanga Research to come and share with you the outlook for 2021, how he sees the recovery in 2021. So if you want stock pick, you must join the next session. Okay. So before we talk about that session, let's talk about account opening. So if you, for those of you who are not yet Kenanga clients and you want to open a Kenanga account, you can fill up this online form. I've just given you the online form. Please fill up your interest and your contact details, and Kenanga will send a friendly dealer representative to serve you. Okay.
Yeah, this session is brought to you by Kenanga and Bursa, right? So make sure you open an account with Kenanga, yeah?
Yes, correct.
All right.
All right. So the next webinar the topic is on the cups of recovery. Okay, like the name suggests, we are going to look at the recovery in 2021. So what are the opportunities and what are the companies that we should look out for? All right, so that will be the speaker will be the head of Kenanga Research, Mr. Koh Hwa Soon, to talk about that. All right, so it's happening on 15 December, 10 days before Christmas. So please block your date. It's on Tuesday, 8:30 to 9:45. Registration link I've just given you along with the account opening form if you are keen to register your interest. So please fill up this. Please go to this registration page to register your interest in this segment. With that, thank you very much, David, for your sharing.
Thank you very much for having me.
Yeah, for your sharing on the portfolio timing. I'm sure that a lot of us also learned a great deal from you on how we can manage our portfolio and what are the considerations we must think before we allocate our hard-earned money into different type of stock. All right, so thank you everybody, and thank you, David, and may you have a pleasant
rest
of the day.
And happy value investing.
Yeah, bye-bye.